Hey everybody, Andy here with Twisted Finances, and in today's video, I will be explaining and comparing the difference between the interest rate of a loan and the annual percentage rate, or the APR of a loan. Be sure to watch the entire video so you know the difference between the two, how to calculate each one, and how you can use this knowledge to compare multiple loans. If you're currently looking at different loans for maybe a car or a house, you may notice that there is an interest rate that you were quoted on a loan, and then there's also an APR, which tends to be higher than the quoted interest rate. So you might be wondering, why is that? It's because the interest rate is just the cost of securing the loan, but the APR includes the interest rate on the loan as well as any upfront cost or loan fees in order to secure that loan. So in order to compare the two, we need to understand which each one means and how it's calculated. So the interest rate on the loan is purely used to calculate the interest expense for that loan. So let's say you finance a new house for $300,000 at 3%. Your yearly interest expense on that loan will be $9,000, and the monthly interest expense is going to be $750. The interest rate on your loan is influenced by the Federal Reserve. So during economic recessions, the interest rates are usually slashed in order to help increase consumer spending. So when interest rates are lower during economic recessions, that means it costs less to borrow money, so more people will borrow money. During strong economic performance or recovery times in the economy, the Federal Reserve will actually increase the interest rate in order to help decrease the amount of lending to try and combat potential inflation. I know, it's a lot of words about banks, Federal Reserve, and interest rates and everything like that. Like, who really gives a shit? But it's little pieces of knowledge like this that helps you understand where your interest rate comes from, so it helps you as a consumer and a borrower to make better informed decisions. And you can also brag to your friends over a pint about how much more you know than them, so it's a little plus. So now that we know that the interest rate is just the cost of a loan, we're gonna look at what the annual percentage rate, or the APR, is for a loan. So when comparing loans, you want to look more at the APR than you do at the interest rate. The APR helps paint a better picture on exactly how much your loan will cost, since it includes any fees incurred to secure that loan. The fees that are typically charged to you are broker fees, closing fees, or loan origination fees. The APR will almost always be greater than the interest rate unless the lender is doing some kind of special promotion that gives you a rebate or a credit. You might see the APR lower than the interest rate, but it's really not that common to come in contact with. So let's take the same exact example that we use for the interest rate and apply it for an APR example. So we're still looking at the financed on the new house of $300,000 at 3%. Let's say that the home that you purchased included mortgage insurance, closing cost, and loan fees for a total of $15,000. To determine the APR on your loan, we're going to add the $15,000 onto the $300,000 purchase price, giving us an entire finance amount of $315,000. So now with the APR calculated, your yearly interest expense is going to increase by $450 up to $9,450. And to calculate what the APR exactly is, all you have to do is take the annual interest expense on the APR loan and divide that by the total financed price, which in this example gives us a rate of 3.15% instead of the basic interest rate example that we did before of just 3%. What usually happens is when you're comparing different loans, consumers get into this world of just pure confusion. You might have 4, 5, 6 different loans that all have the same interest rate, but they all have different APRs. In these situations, you always want to look at the APR because that's telling you exactly how much your loan is going to cost. So if you had one loan that was a 3% and a 3.5% APR compared to another loan that had a 3% rate but a 3.45 APR, then you want the 3.54 APR because you're saving 0.05% on your total loan amount. It's really easy to remember. Just remember, the lower APR means lower upfront costs, which means it saves you more money, which means it's the better deal. I hope this video was able to answer any or all of your questions. If you have any additional comments or questions, just let me know down in the comments. I'll be more than happy to help you. If this video did add value to your life, go ahead and smack that like button on the ass. You know the deal. Feel free to subscribe. We put out financial content every single week to help increase the financial literacy of the population. If you're interested in starting to invest your money, then you can go in the description. I've got 4 links down below that give you stock, crypto, money that will help you start your investing journey today. As always, I hope you have an amazing day, and I'll catch you next time.